entirely outside the public eye, well, you are in the exact right place.
To really grasp this, we first have to talk about the sheer, mind-boggling scale of the money involved. Globally, back in 2015, roughly $19 trillion in assets were controlled by just 79,000 families. 19 trillion! That is a pool of wealth so massive, it literally rivals the gross domestic product of entire superpowers. And it's all concentrated in the hands of a remarkably small group of people.
So that begs a pretty obvious question. Who is quietly managing all this money? Because it's definitely not your neighborhood bank branch, and a lot of times it's not even a traditional Wall Street wealth management firm. We are going to answer this exact question today by exploring an intensely private structure designed specifically to keep extreme wealth growing.
Here is our roadmap for today. We're going to start with the barrier to entry, define what these offices actually are, look at their daily operations, trace their history, and wrap up with the modern regulatory battles they're facing right now.
Okay, Section 1, the ultimate wealth secret, and the price of admission. You can't just walk in off the street and open one of these. A family generally needs at least $50 to $100 million in investable assets to even justify this setup. And to be clear, we aren't talking about the value of a massive family estate or a fleet of nice cars. We are talking about highly liquid investable capital. Anything less than that, and the underlying costs of running this machine simply don't make sense. And that really illustrates just how deep this rabbit hole goes. According to Wharton Magazine, for many of these single-family offices, or SFOs as they're called, a $100 million fortune is literally just the starting line. More than half of them are actually managing family wealth north of $1 billion. We are talking about a completely different stratosphere of finance here.
Moving to Section 2, what exactly is a family office? Let's break down this corporate structure. At its core, a family office is just a private company. It's a privately held corporation or an LLC, complete with officers and a dedicated support staff. But instead of selling software or manufacturing consumer goods, its absolute sole purpose is handling the investment and wealth management for one wealthy family, making sure that money safely transfers to the next generation.
Think of it like this. It operates with a CEO and a staff, just like a regular company you'd see anywhere. But instead of generating revenue through a traditional product or service, the company's financial capital is simply the family's own wealth. The officers running it are paid directly by the family, often with massive incentives tied to the capital gains they generate. It's essentially a business where the only client is the owner. Section 3, managing more than just money. Because while growing the wealth is the main goal, their daily operations go way beyond just picking stocks. These offices essentially act as a centralized hub. They manage the entire family fortune and their lifestyle. We're talking day-to-day accounting, paying the household staff, booking complex global travel, running private philanthropic foundations, and even tackling the really intricate legal matters of succession planning. They are basically full-service life managers for the ultra-wealthy.
Now, as you can imagine, providing all these highly personalized, comprehensive services does not come cheap. It can cost well over $1 million a single year just to keep the lights on and pay the staff. And this is exactly why you need that $50 to $100 million baseline we talked about earlier. If you only had $10 million, burning $1 million a year just on administrative overhead would bankrupt you in a decade. So, to cover those massive overhead costs and actively grow the fortune, family officers put that money to work. They deploy capital strategically into core assets. They dive into private equity and venture capital to take stakes in growing businesses. They buy up commercial real estate. A lot of them lean heavily into hedge funds to hit specific risk and return goals. And sometimes they just act passively, allocating funds to outside managers to do the heavy lifting for them. On to Section 4, the rise of family wealth. Let's look at how this hyper-specific structure became the absolute standard for the super rich. The history here is actually pretty incredible. It all started way back in 1834, when the founder of DuPont Dad and his sons essentially formed an early family office to manage the wealth from their gunpowder mill. Later in the 19th century, the Rockefellers really formalized the model. Fast forward to the 1980s, the ranks of the super rich swelled, and so did the number of these offices. And then, in the 2010s, the explosive valuations of tech companies created a brand new generation of billionaires who instantly turned to this exact playbook. But here's an interesting twist. as they've grown in popularity, they've actually sought even deeper discretion. A 2015 report by the Financial Times noted that families are quietly dropping the term family office altogether. Instead, they're using alternative, super vague names like private investment office or saying they offer private company services. The goal is obvious: maintain an incredibly low profile while quietly managing massive sums of money. Which brings us to our final section, under the regulatory microscope. Because today, this extreme desire for privacy is clashing head-on with government oversight.
Just look at this quote from a solicitor during a 2011 SEC rulemaking period. It perfectly captures how fiercely these families protect their privacy. Around 100 family offices communicated with the SEC exclusively through their attorneys, using solicitor-client privilege. They explicitly argued that even providing public comments on new rules might compromise their privacy and reveal how they conduct business. They really don't want anyone looking under the hood.
So here is how that 2011 situation actually played out. After the 2010 Dodd-Frank Act, a previous loophole called the less than 15 clients rule was eliminated. Suddenly, single-family offices faced the threat of having to officially register as investment advisors. In response, they organized a highly successful lobbying effort through the Private Investor Coalition, and it worked. The SEC issued final rules formally exempting single-family offices from having to meet those investment advisor criteria. They legally secured their right to operate in the shadows. But the spotlight recently swung right back onto them. In the spring of 2021, Archegos Capital Management explosively collapsed. That implosion suddenly threw family offices back under the microscope, catching the attention of regulators like the U.S. Senate Banking Committee. It became very publicly apparent that family offices function with significantly fewer disclosure requirements and are far more loosely regulated than other traditional investment vehicles. And this has sparked a pretty fierce, ongoing debate in Washington. You have lawmakers like Representative Alexandria Ocasio-Cortez pushing for more oversight, proposing a bill that would actually cap the SEC exemption for family offices at $750 million. But on the flip side, you have regulators like SEC Commissioner Hester Pierce and CFTC Commissioner Brian Quintens arguing that, hey, these offices are managing their own money, so they simply don't need new, burdensome regulations. Which leaves us with a massive question looking to the future. Will this ultimate wealth secret remain in the shadows, allowing private families to quietly manage their wealth however they see fit? Or will those $19 trillion, which is definitely still growing, soon face the glare of public oversight? As extreme wealth continues to expand globally, how we balance private family fortunes with public market stability is absolutely going to be something to watch. Thanks so much for joining me on this explainer. Keep asking questions, and I'll see you next time.